In this video, we take a look at the markets from a short, intermediate, and long-term perspective. As we head into Friday's session, these first four bullets here are the topics we're going to focus on. In this video, we also have to keep in mind that there is a G8 summit this weekend at Camp David, and obviously there'll be some type of positive statement or rhetoric that comes out of that meeting. Whether or not there's any substance is doubtful, but we could see some type of bounce in the futures or a bounce in the markets on Friday, Monday, Tuesday in anticipation of that. Based upon what we know right now, and it's important that we keep an open mind, it's possible that any oversold rally or Camp David induced bounce might be similar to the bounce that we had in 2011, which was relatively short-lived. But we'll keep an open mind, and volume will tell us a lot. If we get a strong move with volume behind it, then maybe we can get something more substantial. Quick update here on the status of our proprietary market models. If you want to learn more about these models, you can find a link about the 80/20 correction index and the bull market sustainability index on the left-hand side of our homepage. And there's a video on the right-hand side of the homepage explaining the new risk model that we developed relatively recently. What we've got here is, here's where the models sat on May 4th, 2 weeks ago. The fastest model that we have is this risk model. What this tells you is this is where the models tend to bottom on a correction that would be typical or one that you would want to ignore. Our concern 2 weeks ago was that the risk model at 56 was about to potentially breach that leave it alone, relatively shallow correction level. And as you can see, between now and then, we've lost 65 points on the S&P 500. On May 4th, we closed at 1369. On the 17th, Thursday, we closed at 1304. The point now is all the models and the composite model are all below these leave it alone levels, which means we've moved firmly into neutral territory and are knocking on the door of bearish territory. So things are weak. They still need to be watched, and we'll keep an open mind about where we go from here. What we're looking at here is a DeMark chart, and DeMark indicators and charts are proprietary tools from Market Studies LLC. We're looking at the E-mini futures here, so these are S&P 500 futures. This is a short-term chart. This is a 60-minute chart, and you could ask if you have a longer-term time horizon and you're an investor rather than a day trader, why would you ever look at a 60-minute chart? Well, longer-term trends and intermediate-term trends have to change on shorter-term charts before they change on a longer-term chart. And what you'll find in the futures here is we've got kind of a mixed bag. This is the current session this morning before the open on Friday. The futures are up a little over 5 points. And what you'll see here is this is during yesterday's session. This is a 9-13 combination exhaustion signal here. This is the level that you would like to see the market hold if this is a good reversal signal. And as you can see in yesterday's session, we breached this level. Now, mathematically in DeMark speak, it hasn't met the criteria to be a full breach yet, but the sheer fact that we penetrated this line tends to be bearish. So the point is, during yesterday's session on Thursday, we had a bearish development on a 60-minute chart. Now let's look at a 30-minute chart. You can see this morning we've had a potentially bullish development. Now we're looking at the same chart. This is just the 30-minute version. Here's the potentially bullish development here. These are DeMark trend lines. You can see we're in somewhat of a triangle formation here that we broke out of. This is a DeMark propulsion target, which says typically a market would hold in here, which would be bullish for these futures. But the real bullish development is, see how this line here is solid relative to the one that we looked at on the previous chart that was a lot harder to see. this is a qualified bearish break of this line, which tends to be bearish. This blue line here is a qualified bullish break based upon this 9 count going down. So what matters for us is on a very short-term chart, it looks like the market is trying to shift. Whether or not it pulls that off or not remains to be seen. But the fact that these trend lines were drawn here by DeMark's system and they slope upward says that on a very short-term basis, the futures are trying to turn around. Now, we could obviously break below here and come down here, would be another potential target. So this doesn't mean a whole lot yet, other than before we head into Friday's session, it probably pays to keep an open mind about a surprise on the upside. Whether or not that materializes, we really don't have enough information yet. This is the chart that we looked at on Sunday night. This is the E-mini futures. This is the daily version. And on Sunday night, we were up here, and you can see that video. Find it on our YouTube channel or on our website somewhere in short takes. The point is, here's the congestion areas that we were concerned about. We broke below that. Points here are a propulsion target is still at 1280. You can see we got the 9 up here. The way these counts work is a 9 and a 13 tends to be exhaustion. The fact that this line is solid means that this turned out to be a bad signal, which is actually bullish once this turns solid. 9 and a 13, solid, bullish, means the signal wasn't a good signal. We haven't gotten to a 913 here. You can typically get a bounce when you get a 9 and an up arrow. Usually you look for that bounce to occur within 4 bars. So we could still get a bounce off of this 9. Here, to get to a 13, we would need weakness for about 7 more trading days. So as far as DeMark speak goes, another downside target, these adjust, is now down to 1243. On the bullish side of the ledger, you can see he's added the automatic systems, the propulsion system, has added an upside target all the way up to 1481. So are we going to get there? We don't know. It pays to keep an open mind, especially when you start coming down near some of these red targets and you've got a 9 up. So we'll just see how things play out. Let's move quickly to the weekly chart, and then we'll finish up with DeMark. Here's the weekly chart. This is kind of a mixed bag. From a bearish perspective, this is the yellow momentum propulsion line that was broken, which says that the momentum starts to pick up. The good news is we've actually hit this target here in today's session, which was around 1298. This says this could be a logical area for a bounce. The second target's down here at 1280. Another good piece of news is this target up here says the door could be open on a weekly chart all the way up to 1454. What you'd like to see is the market to clear this yellow line, and then the odds would say that momentum would shift upward from there. So the weekly chart's kind of a mixed bag here. On a bearish note, if we go look at the counts, these are the DeMark counts here, and I guess you could say this is bullish too. The bullish perspective that this is combo is only on an 11, which says we'd have to come up here and make a higher high to get to a 13. From a bearish perspective, this down count for exhaustion going in this direction is only on a 5, which would say that we'd move to a 6 at the close today. And to get to a 9, it would say that we would have to have 7, 8, 9, 3 more weeks of weakness to get to a 9 up. So this is somewhat of a mixed picture. This is the combo count. Let's look at the sequential count. DeMark's got 2 major counts. Sequential's also on a 5 here, which would say more downside to get to a 9. This is good news here, though, as we mentioned. And this also says to get to a 13, we could have more upside. So have to be open to upside here and potentially somewhat limited downside, potentially being capped here. We could blow right through this. Doesn't mean we're going to hit these targets. What it means for us is keep an open mind about where we could go in this direction and this direction. Here we're looking at one of the charts that we use in our proprietary market models. This is SPY, or the S&P 500 ETF, as a ratio, SPY divided by IEF, which is the 7 to 10 year Barclays Treasury ETF. So you can think of this as the ratio of stocks to bonds, or the ratio of risk on to risk off. When the ratio is rising, risk is in favor. When the ratio is falling, bonds are in favor, or risk off is in favor. We use these moving averages in this part of the model, and we use numerous charts like this. This is just one of them. The point of the exercise here, we are in the process of potentially getting a bearish cross as we head into Friday's session. This is a weekly chart, so what really matters is how we finish out the week. It's possible that if we have an up day on Friday, that this chart as of the close will look more like this with a gap in between it. But right now it looks like it's trying to make a bearish cross. The last two times we got a bearish cross, we got one on May 18th of 2010. We got another one here on June 3rd, 2011. What we care about is after this bearish cross, the S&P 500 fell an additional 9% between the close on May 18th and the intraday low on July 1st, 2010. After this cross here, the S&P 500 fell an additional 17.3% from the close on June 3rd to the intraday low on October 4th. How is this relevant for us today? It says keep an eye on this as we finish out the week, and if we do indeed get the bearish cross, which has not happened yet, this blue line is actually slightly above the red one as of the close on Thursday, May 17th. If we get the bearish cross, it would just add to our concerns, and we have to understand once you get the cross that it took the market from May 18th to July 1st to bottom, and it fell quite a bit further. Here it took from June 3rd to October 4th to find a bottom and fell quite a bit further. So just one of the many charts that we're monitoring. This is built into our systems and into our models. It just gives you an idea of the things that we track and monitor on a daily basis. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.